Welcome to the X Project Podcast. This is a podcast of the X Project Substack. To subscribe, please go to thexproject.substack.com. What are BTFP, ONRRP, TGA, and QT? And why does April 18th matter? And why should I care about this alphabet soup of technical jargon? Article number 45, published March 24th, 2024. First, a note for podcast listeners. This article contains 9 important charts. If you are not driving, you may want to open the article to scroll through to the charts to view while you listen. Again, only if it is safe for you to do so. This article is slightly longer than most. This is the X Project's 45th article since mid-November without a pause, and so next week is spring break, and there will be no more articles in March. On Wednesday, April 3rd, the 2 articles per week on Wednesdays and Sundays will resume. In this article, the X Project will answer these questions. Section 1, why this article now? Section 2, what is the BTFP and why do I care? Section 3, what is the ONRRP and why do I care? Section 4, what is the TGA? Section 5, what is QT? Section 6, what's happening on April 18th? Section 7, what else needs to be considered regarding the TGA? Section 8, what about the MOVE index and DXY? Section 9, what does the X Project guy have to say? And as always, Section 10, why should you care? The charts in this article are as of Thursday, March 21st, as this article was written in advance of Sunday's publication. Reminder for readers and listeners, nothing the X Project writes or says should be considered investment advice or recommendations to buy or sell securities or investment products. Everything written and said is for informational purposes only, and you should do your own research and due diligence. It would be best to discuss with an investment advisor before making any investments or changes to your investments based on any information provided by the X Project. Section 1. Why this article now? In the shadow of an economic landscape rife with uncertainty, questions among traders, strategists, and analysts as to how the U.S. government's colossal debt is going to get funded and by who is growing louder, no doubt being heard in the corner offices of power and finance. As we stand in the middle of historic monetary and fiscal maneuvers, the implications for the nation's economic stability and the global financial order are immense. In article number 9, an introduction to inflation, what is its relationship to interest rates, government debt, deficits, and fiscal dominance, the X Project shared U.S. government debt data along with actual interest expense data and true interest expense data, which includes mandatory outlays for Social Security and Medicaid. The conclusion was that monetization of the debt and yield curve control is a future probable outcome, and these topics will be revisited below. Then, in article number 17, everyone is missing the point about the Fed's rate cuts in 2024. What is the point? What does it mean? And what can we expect? The X Project discussed the U.S. Treasury market and the 5 episodes since 2019 which proved the limits to how deep and liquid the market is. In each of those 5 episodes, when the U.S. Treasury market became dysfunctional, or the Merrill Lynch Option Volatility Estimate or MOVE Index spiked, the Federal Reserve and or the U.S. Treasury came to the rescue with some form of dollar liquidity. The conclusion of the article was this, quote, the Fed had no choice, quote, The Fed had a choice to continue fighting its fight against inflation, but that would sacrifice the US Treasury market, which would spike yields to extremely high levels, which would send the US dollar to the moon, which would crash the economy, creating a financial crisis along the way. Inflation would be killed, deflation would be rampant, the US dollar would be very strong, and we would suffer a deep and prolonged economic depression. Instead, the Fed decided to save the US Treasury market. You should expect the US dollar to weaken in the short run, 3 to 6 months, perhaps through next year's presidential election. This will drive US asset prices higher, GDP growth higher, US tax receipts higher, and US Treasury yields lower, as that should all help reduce the amount of US Treasury issuance. End quote. So, where is the MOVE index for the US Treasury market now? This article will examine it later. Most recently, in article number 37, why rate cuts, a lower US dollar, and inflation will all be returning soon, revisiting fiscal dominance and the US policymakers' only choice. The X Project revisited the debt problem, the current environment marked by fiscal dominance, and the US policymakers' only choice, a lower dollar. Where is the dollar trading now? We will also take a look at it below. So, why this article now? It's all in the title. So let's examine each for starters. Section 2. What is the BTFP and why do I care? You probably heard of this one before. BTFP is the Federal Reserve's Bank Term Funding Program, an emergency lending facility designed to bolster market confidence and ensure liquidity in the banking system after the collapse of Silicon Valley Bank on March 10, 2023, the third largest bank failure in US history. The BTFP aimed to provide a backstop to banks and other eligible financial institutions, allowing them to borrow funds for up to 1 year against a wide range of collateral, including treasuries, agency debt and mortgage-backed securities, and other qualifying assets. One of the key features is that the institutions that use this facility could borrow the full par value of the security they pledged as collateral, even if the security's market value was substantially less than par. Here is a chart of the BTFP's usage since last March. The BTFP ceased extending new loans on March 11, 2024. Many market observers were surprised that the Fed did not extend this program. While $167 billion is not a huge amount, dollar liquidity was provided into the financial system over the last year, and the lending program alleviated a lot of stress on the institutions that needed to use it. This $167 billion will now have to be paid back over the next year, which will take dollar liquidity out of the system. Why do I care about dollar liquidity and whether it increases or decreases? As was covered in article number 35, The Rising Tide of Global Liquidity Lifting All Assets, Michael Howell's powerful analysis and provocative forecast. Global liquidity flows drive asset markets, which drive the broader economy. The BTFP was a tailwind that was adding to global liquidity, and now it has become a headwind. Section 3. What is ONRRP and why do I care? The ONRRP is the Overnight Reverse Repurchase Agreement Facility, and it is a monetary policy tool designed to help the Federal Reserve control short-term interest rates and maintain the federal funds rate within the target range set by the Federal Open Market Committee, or FOMC. This facility involves the Fed selling securities to eligible counterparties with an agreement to repurchase them the next day. The Fed engages in these overnight transactions with various counterparties, including banks, money market funds, and government-sponsored enterprises. These counterparties lend cash to the Fed overnight in exchange for Treasury securities with a set agreement to sell the securities back at a slightly higher price the next day. The difference in price effectively represents the interest rate on the cash lent to the Fed. The Fed can influence other short-term interest rates by setting the rate at which it conducts these reverse repurchase agreements. The ONRRP rate serves as a floor beneath which short-term rates are unlikely to fall because eligible institutions have the option to lend to the Fed at this rate, making it unattractive to lend at lower rates elsewhere. The primary purpose of the ONRRP facility is to help keep the federal funds rate, the interest rate at which depository institutions lend balances at the Federal Reserve to other depository institutions overnight, within the target range established by the FOMC. This is a key part of the Fed's broader mandate to manage the financial system's liquidity level and influence economic conditions. The facility also helps manage the amount of liquidity in the banking system. On days when there is excess liquidity, for example, when banks have more reserves than they desire, the overnight reverse repo facility can help absorb some of that liquidity by taking cash out of the system in exchange for securities. By providing a reliable investment option, the overnight reverse repo facility helps support the stability of money markets, especially in times of financial stress when demand for safe, short-term investments increases. Here is a chart of the overnight reverse repo balances over the last 5 years. Prior to early 2021, the overnight reverse repo balance was virtually $0. The low usage of the overnight reverse repo facility at the start of 2021 was due to relatively balanced liquidity conditions. However, as the year progressed, the U.S. government's fiscal stimulus packages aimed at mitigating the economic impact of the COVID-19 pandemic significantly increased liquidity in the banking system. This stimulus and the Federal Reserve's asset purchase program, quantitative easing, led to a significant increase in bank reserves and money market funds cash holdings. With more cash seeking safe short-term investment, demand for the overnight reverse repo facility increased as it offered a secure option for parking excess liquidity. Throughout 2021 and 2022, inflation rose significantly, prompting the Federal Reserve to adjust its monetary policy stance. This included signaling and implementing interest rate hikes beginning in March 2022 and ending in July 2023 for a total increase of 5.25%. As the Fed began to raise interest rates to combat inflation, the interest rate offered through the overnight reverse repo facility became more attractive, leading to increased participation from money market funds and other financial institutions seeking higher yields on their cash reserves. The overnight reverse repo balance surpassed $2 trillion in June 2022. A broader market search for safe assets also drove the significant demand for the overnight reverse repo facility. In a context of market uncertainty and adjustments to monetary policies, institutions look to the safety of the Federal Reserve's reverse repos. By June 2023, the overnight reverse repo balance fell below $2 trillion for the first time in a year and has continued to fall to less than $500 million today. Higher interest rates across the economy made other investment options, most notably U.S. Treasury bill yields, more attractive than the overnight reverse repo, leading financial institutions to adjust their liquidity management strategies. And then, as was pointed out in article number 37, finally, on November 1st, the U.S. Treasury released the Treasury Borrowing Advisory Committee, or TBAC, reports and recommendations. And there were three overarching takeaways. The first is the conclusion that the long end of the yield curve is not nearly as deep and liquid as everyone thinks. The second conclusion is that the largest marginal buyers of U.S. Treasuries since 2021 have been highly leveraged hedge funds participating in the basis trade, where they profit on the slight difference in prices and yields when buying cash U.S. Treasuries and selling U.S. Treasury futures with 50 to 500 times leverage. The U.S. Treasury needs someone to buy its debt, even if it means accepting the systemic risk that comes with the enormous amount of leverage being used. The third takeaway was the TBAC's recommendation. The committee supported meaningful deviation from the historical recommendation of 15 to 20% T-bill share. In acknowledgement of the long end of the curve not being liquid enough, the U.S. Treasury needs to shift its debt issuance toward the short end of the yield curve, including significantly more than 20% of the debt issued in short-term bills. End quote. The overnight reverse repo facility has been a major source of dollar liquidity, with much of that liquidity going to purchase T-bills, which are the most highly desired collateral used for lending throughout our financialized economy. Lending creates new money. Over the last 8 months, from June 30th, 2023 to February 29th, 2024, the overnight reverse repo has been losing an average of $183 million per month, leaving less than 3 months before it runs out. But it might not go back to $0 and may stabilize at some lower level. In either event, where will dollar liquidity come from once the overnight reverse repo stops shrinking? Section 4. What is the TGA? The TGA, or Treasury General Account, is the main operating account of the U.S. Treasury Department held at the Federal Reserve. The Treasury uses this account to manage the government's money. Essentially, it's where the federal government keeps its cash to pay for day-to-day operations and meet its financial obligations. The TGA receives deposits from various sources, including tax revenues and proceeds from the sale of Treasury securities. It is also used for government disbursements, such as paying for federal programs, servicing the national debt, and other expenditures authorized by Congress. The TGA plays a critical role in the Treasury's cash management strategies. The Treasury manages the account's balance to ensure there are sufficient funds to cover the government's obligations without maintaining excessively high balances that could withdraw liquidity from the banking system. Here is a chart of the TGA's balance over the past 5 years. As you can see, the TGA swelled from 400 billion in early 2020 to 1.8 trillion in July 2020 as the COVID-19 panic caused the Federal Reserve to cut interest rates from 1.5% to 0% in March of 2020. Those cuts, plus the panic in financial markets, created a huge surge in demand for safe haven US Treasuries, and so our Treasury took full advantage of selling a lot of bills, notes, and bonds to create the war chest of cash needed to fight the pandemic. Over the next year and a half, the Treasury spent that cash into the economy due to the massive fiscal stimulus programs implemented. The low points in the cash balance you can see in the chart in October 2021, December 2021, and May 2023 coincide with the debt ceiling, temporarily curtailing the Treasury's ability to issue more debt and raise more cash. Today, the balance sits at approximately $750 billion, which is near the high end of the range from $964 billion to $49 billion that we've seen since the summer of 2021. From 2015 to 2020, the TGA was mostly between $300 and $400 billion. $750 billion seems like a healthy balance, right? Well, we need to consider what's changed since 2015 to 2020. Section 5. What is QT? QT stands for quantitative tightening, which is the opposite of QE or quantitative easing. Both refer to the Fed's balance sheet. QE is when the Fed expands its balance sheet by buying securities, specifically US Treasuries and mortgage-backed securities, or MBS, from the market. QE adds liquidity into the financial system as money is created by the Fed to buy those securities, and that money ends up in the economy, or at least in our financial markets. We learned of and became familiar with the multiple QE programs dealing with the Great Financial Crisis, or GFC, in 2008 and the aftermath. Here is a chart of the Fed's balance sheet going back to 2007, in which you can see it going from around 900 million prior to the GFC to 4.5 trillion in 2014. The opposite of QE is QT, when the Fed shrinks its balance sheet. This is done by either selling treasuries and MBS or letting them mature, which removes them from its cash balance. Both remove liquidity from the system. When the Fed sells a security it owns, someone buys that security by giving the Fed the cash, removing that cash from the system. When a US Treasury matures, the owner of the bond, or note, or T-bill gets paid back the face value of the Treasury by the government, and the government pays that out of the TGA. When the Fed is the owner of the maturing security, money is transferred from the TGA to the Fed, which has no effect on liquidity in the system. However, it does reduce the TGA, indirectly reducing future liquidity, as the TGA won't have that money to spend on the economy. Returning to the chart of the Fed's balance sheet above, you can see that it increased slightly and briefly during our brief banking crisis last March. Since then, over the past year, the Fed's balance sheet has shrunk by about 1.2 trillion, or roughly 100 million per month. The point here, for now, is that some portion of that 100 million per month directly reduces the liquidity of the economic and financial system when the Fed sells securities. Some portion indirectly reduces future liquidity by reducing the TGA when the Fed securities mature and it gets paid back the security value. The Fed is aware of the impacts discussed so far on the BTFP and the overnight reverse repo, and that is why some Fed officials have been communicating recently that it will begin tapering its QT program soon. After this week's meeting of the Federal Open Market Committee, during which it decided to leave rates unchanged, Chairman Powell said that QT tapering would be a topic at the March meeting of the FOMC. Okay, so let's return to the TGA and see what else it can tell us about the future. Section 6. What is happening April 18th? This is the filing deadline for 2023 federal taxes. The TGA will see a large intake of cash from the receipt of taxes in the weeks immediately following April 18th. Last year, the TGA increased by $210 billion between April 12th and April 26th, 2023. In the year before that, the TGA surged by $421 billion between April 13th and May 4th, 2022. There may have been other factors besides tax receipts, like treasury auctions bringing in additional cash or disbursements reducing cash during those timeframes. However, we can generally expect a few $100 billion increase in the TGA over the last weeks of April, and we would expect a larger increase like in 2022 instead of the smaller increase like in 2023. Why? Because the S&P 500 was up 24% in 2023, and it was down 19% in 2022. As was pointed out in Article 37, tax receipts have become highly correlated with equity prices. The immediate impact of this tax filing event is withdrawing liquidity from the financial system. This, taken together with the end of the BTFP and the shrinking balance of the overnight reverse repo, could lead to some short-term liquidity bumpiness and even an overall liquidity decline over the next several weeks, which could have a negative impact on equity prices. So, returning to the question of whether the $750 billion current TGA balance, plus a few $100 billion coming in over the end of April, which might result in a balance of $1 trillion or more at the beginning of May, is a healthy balance compared to the 300 to 400 million TGA balance over the course of 2015 to 2020. But we need to look at a few more items to see how they compare to then. Section 7. What else needs to be considered regarding the TGA? There are 3 items affecting the TGA that are notably different from the last half of the last decade. The first one is the interest payments on the government debt. Our federal government's debt, which was high pre-pandemic, exploded substantially higher in response to and as a result of the pandemic. Then inflation showed up, and eventually the Fed's interest rate hiking cycle in an attempt to tame inflation. And finally, our government is running wartime budget deficits despite a relatively strong economy. All of these factors are driving our interest payment on our debt to record levels. Here is a 5-year chart of our interest payments. In 2019, our annual interest payments were just under $600 billion. As of the fourth quarter of last year, our interest payments are just over $1 trillion and rising. On a quarterly basis, we went from a little less than $150 billion per quarter to now over $255 billion per quarter. These quarterly interest payments have been rising by a little over $50 billion per quarter over the last 8 quarters. These interest payments are stimulative as they go back into the economy, except those that go to the Fed for their bond holdings, being paid out of the TGA and therefore add liquidity back into the system. The next items to consider are Social Security and Medicare payments. These both have been rising because of inflationary cost of living adjustments, but also because the baby boomer generation, a significantly larger demographic population bulge than either the silent generation that preceded it or Generation X that followed it, are slowly entering retirement, with roughly half that generation having already done so. Here is a chart of Medicare payments over the past 5 years. At the end of 2019, Medicare payments were just shy of $800 billion per year, and as of the fourth quarter of last year, a little over $950 billion per year. Over the last 2 years, when the slope in the chart became less steep, these payments have grown $25 billion per year, or a little more than $6 billion per quarter. And here is a 5-year chart of Social Security payments. At the end of 2019, Social Security payments were $1.042 trillion. And as of the fourth quarter 2023, they were $1.374 trillion. Over the last 2 years, the payments have grown $124 billion per year on average, or about $31 billion per quarter. If we assume that these quarterly averages continue, then we can see that the TGA needs to pay out about $86 billion more every quarter going forward. Given that assumption, it makes sense that the Treasury needs to maintain higher balances now compared to the end of the last decade. Even still, pushing $1 trillion still seems like a bit much. Why else might the Treasury have built up a large balance? Section 8. What about the MOVE index and DXY? Let's first take a look at the MOVE index, which was first introduced in article number 17. No problems. In fact, the MOVE index is the lowest since February 2022. This makes sense for 2 reasons. First, remember the quote above in section 3 from article 17. That last part helped the decline in the MOVE index from the October 2023 spike. And then on January 29th, 2024, in the Treasury's quarterly refunding announcement, quote, the U.S. Department of Treasury today announced its current estimates privately held net marketable borrowing for the January through March 2024 and April through June 2024 quarters. During the January to March 2024 quarter, Treasury expects to borrow $760 billion in privately held net marketable debt, assuming an end of March cash balance of $750 billion. The borrowing estimate is $55 billion lower than announced in October 2023, largely due to projections of higher net fiscal flows and a higher beginning of quarter cash balance. During the April through June 2024 quarter, Treasury expects to borrow $202 billion in privately held net marketable debt, assuming an end of June cash balance of $750 billion. End quote. The Treasury does a good job of managing expectations by projecting a higher number initially, lowering the estimate, and then borrowing even less than estimated. The amount for the April-June 2024 quarter surprised many by how low the estimate was, and of course, it's because the stock market did well last year and therefore Treasury knows tax receipts should be strong. We'll see, but the January QRA helped to continue driving the MOVE index lower as Treasury auctions continued without any major hiccups. How about the dollar? Here is an updated 5-year chart of DXY, or the dollar index. Unlike the MOVE index, the dollar is not at 2-year lows. The dollar index hit a low of 100.62 on December 24th, 2023, and a recent high of 104.98 on February 11th. It is currently just above 104 and seems to be threatening going higher. This could be a sign of the potential for liquidity conditions tightening a little in the short term. In the next section, I will explain what I think about all of this, and then in the final section, why you should care and, more importantly, what more you can do about it. However, I have just hit a new paid subscriber threshold, and so you now have to be a paid subscriber to view or hear the last 2 sections. The X Projects articles always have 10 sections. Soon, after a few more articles, the paywall will move up again within the article so that only paid subscribers will see the last 3 sections, or rather, free subscribers will only see the first 7 sections. I will be moving the paywall up every few weeks, so ultimately, free subscribers will only see the first 4 or 5 sections of each article. Please consider a paid subscription. All paid subscriptions come with a free 14-day trial, and you can cancel anytime. Every month, for the cost of just 2 cups of coffee, the X Project will deliver 2 articles per week, helping you know in 1 to 2 hours of your time per month what you need to know about our changing world at the intersection of commodities, demographics, economics, energy, geopolitics, government debt and deficits, interest rates, markets, and money. You can also earn free paid subscription months by referring your friends. If your referrals sign up for a free subscription, you get 1 month of free paid subscription for 1 referral, 6 months of free paid subscription for 3 referrals, and 12 months of free paid subscription for 5 referrals. Please refer your friends. Thank you. This concludes the X Project's podcast number 45. Please subscribe to the X Project's Substack at thexproject.substack.com. have.